Then the final return comes after 6 months when my year ends. When the year ends on 30th June, for example, now we are running the year 2024-2025. It's going to end on 30th June. When that year ends, I give you 6 months into the following year to wrap up whatever you've been doing this year so that you can be able to send me the final income tax return. And by the way, when we register you for tax purposes and give you a TIN, by default, income tax has to be on that TIN. Because you've told us that you're going to do business, you have started business, you're starting business within 2 weeks. So there is nobody who starts business with the hope of making a loss. We all have hopes or anticipations of a profit. So that is why I insist income tax is there, and income tax calls for these 2 returns as you're moving your journey. As I had told you, the due date, if it's a non-individual, for a provisional is after 6 months, that is by 31st of December. Still, the final return for a non-individual takes the same 6 months after the year ends. But payment, the due date for payment is the return date. Then the tax rates applicable. Ideally, whenever we are speaking to you, we basically refer to the law. When you look at Section 4, Subsection 1 of the Income Tax Act, it's the one that talks about income tax and talks about your chargeable income and your registration. So that is why we have words like chargeable income. When we look at chargeable income of a person in a year of income, this is the gross. When you add up the incomes that you do receive from the different points where you have probably invested in, then you reduce the deductions that would be there. Then at the end of the day, that amount that remains is the amount I apply a tax rate on. The applicable tax rates and the tax types thereof. For small businesses, yes, we talk about income tax, but what we did to make it a little simpler for small businesses, in 2014-15, we came up with what is called the presumptive income tax. Presumptive how? We are looking at small businesses as businesses that may not have a chance of hiring, say, an auditor, an accountant to write proper business records for you. You are keeping your records in a counter book, you're writing somewhere. So we did not want to leave out that gap. So we said, let's come up with a presumptive that will be a little easier for filing a return for this category. And when one files under presumptive, it is still income tax, but there I will only be requiring only one return in a given year. I will not wait for the provisional and final. When you go the presumptive way, that means I don't expect a final. I will next see you and I'll next see you next year at more or less the same time. But what you have to note, when you file under presumptive, there are no deductions I give you. As I had illustrated in the previous one, that when you have gross income, you remove the deductions you have, probably incurred in that course of the year, then whatever is a balance is chargeable income. But when it comes to presumptive, I don't expect a small business to have those many deductions, because even the regime I have given you is a softer regime. So if you find yourself making supplies where they even withhold WHT, then at the end of the day, you don't need to file under presumptive because you won't utilize your credit. Corporation income tax is basically the income tax paid by a incorporated business, that's a limited company, and it's a 30% of the chargeable income. I've already explained to you what chargeable income is. When it comes to individual income tax, the rate depends on the chargeable income brackets because they keep shifting. It's progressive, it's a progressive tax. So when it comes to pay as you earn, ideally pay as you earn is registered on entities that do employ staff or people. For example, when you look at a scenario URA, URA is the one that registers for pay as you earn because it knows that it has about 2,000 staff onto whom they are going to deduct pay on a monthly basis and submit it as a return. Though the money comes from my salary, but the duty to register and the duty to submit a return and pay lies on my employer. But if you don't employ anybody, then pay as you earn does not come to you. We have value added tax. Value added tax is basically for businesses that have exceeded 150 years in their turnover. If you add your income in a given year of 12 months and you don't make 150 million, and you even go ahead and look at 3 months, a pattern of 3 months, that's quarterly. If your sales cannot make 37.5 million, then that means you're not yet eligible to register for value added tax. But once you register for value added tax, we have 3 categories of supplies. We have those that pick VAT and they are called standard rated. They pick VAT at 18%. We have those that are 0 rated. They pick VAT at 0 rate. And there are those that are exempted. They do not pick VAT. So if one is dealing in exempt supplies, though they are exceeding 150 million, we don't expect them to register for VAT because whatever they are dealing in is exempt. But if one is dealing in 0 rated, there we expect you to register because you incur VAT when you are expending. So we have to give you a window of how you can claim the VAT on a monthly basis through your return. Then withholding tax. Withholding tax basically is an income tax, but we manage it at the time you are supplying or you are being paid when you supply. And it takes a category of percentages, but the most common is 6% on goods and services. Then 10% goes to advertising commission on advertising agents. Then we have the 15% that is a final tax that goes to dividends, that goes to international entertainers. Then we have the 20% that goes to government bonds. So they are categorized differently. So I just wanted to draw you a picture. If you're to file under presumptive income tax, how do the rates appear? Here we categorize you according to your turnover. As I said, if your turnover does not exceed 10 million, whether you have records, whether you don't have records, there is no payment. Here, why we insist on records, because we feel insisting on records is the way to go, and it inculcates a culture of record keeping into those who do business, so that at the end of the day you pay the right tax. We do not need to presume that maybe pay this. Then we go to those that exceed 10 but don't exceed 30. In case you don't have records, you pay 80,000. But in case you had records, you pay. Let me give you an example. Let's calculate together. We all have calculators. Let me imagine that you have records and you are, maybe your income is 12 million, your gross turnover is 12 million. If it's 12 million and you don't have records, you pay 80. But if it's 12 million and you have records, it tells you 0.4 of annual turnover in excess of 10. That means if it's 12 million, we have to ascertain what is the excess of 10. The excess of 10 is just 2 million. So we multiply 2 million by 0.4%. So I think you see what you get. You're going to pay 8,000 as tax. If you have records with the same turnover, When you don't have records, it would have been 80,000. So that's why I wanted you to get a comparison of why we insist with records and without records. So when you exceed 30 million and you don't exceed 50, in the event that you don't have records, it's 200,000. But if you had records and say maybe you have your turnover was 32 million, if you didn't have records, it will be 200,000. But if it is 32 million and you have records, let's try to calculate and see. It says 80,000 plus 0.5 of annual turnover in excess of 30. So if we are at 32, the excess is 2 million. That we've already established. When we establish the 2 million times 0.5%, that is already 10,000. But we said we add an 80,000. That is 90,000. Can't you see? I think you realize that if you have records, here you're going to pay 90 against somebody with the same gross turnover who doesn't have records, who is paying 200,000. So that's where I wanted you to pick that picture. And we go on until up to 150 million. That is where we stop as in presumptive. So as we continue, these are just tax brackets in case you don't file under presumptive. This is how we count. In case your income does not exceed 2,820,000, because this is a threshold of an individual, that is nil tax. But in case it exceeds but doesn't exceed 4,020,000 shillings, then we are going to ascertain what is the chargeable income. Then we remove this. Maybe your chargeable income is about 5. We are going to remove 2.8, then times 10%. So we go on interpreting the formula like that. Then here chargeable income, in the event that maybe chargeable income is about 4.5, and we remove it from 4,020,000 times 20% plus a 120. So these are just bands to tell us which formula to pick on. So this is an alternative in case you're not filing under presumptive. So this is basically also a payee rates. In case you do employ, this is how you should deduct. We have a threshold for pay as you earn. Once salary that you give your staff exceeds 235, you know that they've entered into the taxing bracket. If it hasn't exceeded, then it is nil, as you see. But once it exceeds 235 but it doesn't exceed 335, then establish the excess of how much it exceeds 235, then times 10. Then the next bracket is it exceeds 335,000 but does exceed 410. Kindly, if this here your income is about maybe 400,000, ascertain how much it exceeds 335. That's a lower band. It will be about maybe 65 times 20% plus 10,000. So you go on computing because it's a progressive tax. I felt we should talk about stamp duty because I think you've heard these days that's one of the things we are selling. So that, yes, you're a lady doing business, but we want to keep you informed so that you do not go wrong in your transactions. As you do transact, stamp duty is just a non-tax revenue that is levied on every instrument listed in the second schedule of the Stamps Act. Instruments are things like an agreement, a memorandum of understanding, a caveat, a release, a cancellation, an affidavit, a mortgage, transfer of land. All those are instruments. And an instrument, to describe it the way we do, it includes that document which gives you a right or liability, or a document that purports you to be, or it creates, or it transfers, or it limits, or it extends. So that's what it gives you, the right or liability to transact within what is in the document. Even tenancy agreements, supplier agreements, agreements to sale of land, agreements, purchase over Chibanja, are all agreements that need to be authenticated by paying stamp duty. So as ladies, normally as we work, we normally buy our small pieces of land, then sign an agreement with the LC. But after signing with the LC, that's not enough. Kindly visit any URA station to help you declare that agreement as an instrument in stamp duty. It will give you stamp duty of 15,000. Pay the stamp duty, then keep everything plus the stamp certificate. You never know when you'll get an issue on that particular transaction.